Darren and I work quite closely with a number of small business owners or owner managers who've looked to sell their business. And so we're really excited to share some of our tips and tricks that we've learned over the years with you today. So we've taken the perspective that you are ready to sell your business, but you just don't know where to start. So we would encourage you to start with some self-reflection. Consider why you're motivated to sell your business. Think of any particular goals you'd like to achieve in this sale process, and understand what your specific areas of concern are. So start out by asking yourself, what outcome do you hope to achieve in this sale process, and what is really worrying you about getting there? Are you planning to retire? Is there an illness in your family that's causing you to step away from the business? Are you ready to move on to something new, a new business venture or a new project? And is there a particular timeline that you have in mind that needs to be met? So is there any milestone that's occurring in your life and you would really like this transaction to be done by that particular time? And have you thought about how you want to exit the business? Are you willing to stay around to help transition the business to a new ownership? Or do you really just want a clean exit? You just want to be done with it and walk away, step away from the business at closing? Are you motivated to achieve sort of the highest possible sale price? Are you particularly concerned about protecting yourself from liability after the closing occurs? Or are you really looking to balance both? We bring all these questions up at the beginning because turning your mind to these points when you're looking to sell your business can really help your advisors navigate the process with you, keeping your goals sort of front of mind. So we would encourage you to reflect on some of these points, consider them with your family, and then speak to your advisors early and often in the sale process, reiterating these points as much as possible, so that your goals are always front of mind and your areas of concern are always front of mind, so your advisors can plan strategically to keep those risks or to minimize those risks for you. We would also encourage you to talk to your fellow shareholders. Are your shareholders family members? Are they sort of third-party investors that have come along as your business has grown? What's their propensity to sell? Do you predict any friction in that process, or is everybody on board with the sale process and everybody has goals that align? Again, we encourage you to have those discussions fairly early in the process and have those discussions with your advisors on board so that everyone is aware of where everyone's motivations are, what everyone's concerns are, and where there's potential for friction that can be dealt with early on in the process and avoid any undue delays and expenses as you kick on. The next thing is to consider is who might be buying your business, and Darren's going to speak to that point next.
Yeah, thanks, Renee. So, some of the things we're going to talk about today will be, what is exactly you are selling, how you're going to promote your business, and the fact that you are selling it. But before that, it's important to understand who might be the buyers. And generally, there's three categories of buyers. There's a cash flow buyer, a strategic buyer, and maybe an asset buyer. And I'll explain the differences really quickly. So the cash flow buyer is someone who's interested in buying your business as an operation as it is today, with the intent of being able to return a profit or return a positive return on investment for the money that they're putting into the business. Most likely, it's not somebody who's looking to buy a job, because there's lots of jobs out there and people can find them. So the business needs to support the owner and pay a salary, but it does also need to provide a return on capital for against the amount of money that they put in to purchase it from you. The second type of buyer is a strategic buyer. So for sure, they're interested in the cash flow, but it might be somebody that's in your business and wanting to expand into your geographical area. It might be a competitor who's in your space and in your area already that's looking to do a consolidation play and get the benefits of some economies of scale. Or it might be somebody who's in your market space, but looking for some vertical integration, meaning that you maybe supply them or they supply you, and they think that there's benefits to owning that entire supply chain. The third buyer that I talked about is an asset buyer. And that's really someone who just wants something specific from your business. So that might be, something like equipment. It might be human resource assets, might be goodwill, like a customer list or client relationships. So they may not be looking for all of the physical plant and the processes. They might just be looking for certain elements of the business. Renee, I'll turn it back to you.
Yeah. And so I think Darren and I will reiterate a few points throughout this presentation. But the first is engage with your advisors early. Find legal consultants or legal advisors, financial consultants, tax consultants that you trust, that are a fit with your value system, and that you get a good feel from, and engage with them early and engage with them often. For you, this may be the single most important and significant financial transaction of your life. It is possibly going to be one of the most stressful, and engaging with advisors early can help take some of that stress off of your shoulders and load it onto your advisors. And that allows the advisors to guide you through that sale process, utilizing the knowledge that they've gained throughout, years of doing these types of deals. Engaging with advisors early in the process can help you preempt sort of purchaser due diligence requests and requirements, can help foresee potential pitfalls in the process for you and avoid them or navigate them efficiently and effectively for you, and can also help minimize risks that you might experience in the deal if you were navigating them alone. And that's particularly important. I'll say it now, and it's probably the point I will end on, but it's much easier to preempt and avoid problems at the outset than it is to fix them after they've occurred. So engaging with your trusted advisors early really can increase efficiency throughout the sale process and minimize risks to you. And we at Field and at KWB, treat it as an honor to help our clients participate in these significant transactions, and we really do appreciate how monumental they can be to someone who's invested their entire lives into a business. So we encourage you to go out, meet people, and find the right people that work for you and your business in this process. Darren, over to you.
Yeah, I couldn't agree more, Renee. And you made a great point that you've probably put a significant amount of time into your business, and you want to maximize the value that you're getting out of that. Working with the advisors, we want to help you make sure that you have the business, make it as attractive as you can to the purchasers, so it's as easy as possible for them to make the purchase decision, right? So I always relate to it as being similar to selling your home, right? Most often, if you're going to list your home, you clean up all the junk out of the yard, you cut the grass, maybe paint a few walls, you stage it, move some furniture around. There's this whole process about going through to make that home more attractive to a buyer. And a business is really no different, or it shouldn't be any different. You can sell it as it is, or you can do a bunch of work ahead of time to make it a little more attractive. So, things like getting rid of redundant assets, obsolete assets, ensuring, Renee's mentioned this a bit already, ensuring you have some good contracts with key suppliers, customers, because a buyer can't rely on a handshake that you have with a third party. You want to reduce the amount of risk to the buyer, and having some good solid contracts that are transferable to a new owner are really important. And Renee will talk about more of that a little bit later. And the third thing for now is just good quality financial information. I mentioned earlier that the buyer is most likely buying it for cash flow reasons. They want to be able to review your financial data, take a look at it.
Could you say that again?
Sorry, and Siri's trying to interrupt my conversation here. They're going to want to have some good information and understand the business well before they make that buy decision. So let's talk briefly about how your business value is determined. And we're going to focus mostly on the cash flow buyer, because that's the majority of deals that we see. Generally, a business is worth more than the sum of its parts. So rather than a fireside sale of assets, you're buying it as a whole to operate it and generate and get the benefit of the cash flow that comes out of that. So we'll often hear people talk about getting a multiple of earnings with respect to the price on the sale of their business. Real quickly, and this would be another whole seminar in itself, but you'll hear people talk about an acronym EBITDA, which is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. it's a normalized income before we have things like interest and taxes and depreciation. So it provides a standardized type of cash flow that the business can generate. So generally, if somebody says, I'm going to get, I got 4 times EBITDA or 4 times earnings, the buyer was looking for a 25% return on their money. If a buyer is willing to pay 5 times your earnings, they're looking for a 20% return on their money. So those are, the range of multiples anywhere from, 1 to 10 or greater has everything to do with what the buyer thinks that they can do with the business and what the risks are related to the business. The higher the risks, the higher the expected return and the lower multiple that they will achieve. And those risks can be anything from external risks like industry that the business operates in, general economic conditions, or it can be internal risks with respect to how well does the business operate.
Darren, can you say what that acronym is again, please? We had somebody ask if you could repeat what that stands for.
Oh yeah, sorry, you bet. So EBITDA, I can throw it in the chat when Renee jumps in, but it's earnings before interest, taxes, depreciation, and amortization.
Thank you.
Perfect. Awesome. Thank you so much, Darren. So another question to consider is, can the business run without you? Are you, really a huge selling feature of this business? And how can we market you to a potential purchaser? One of the critical questions that you'll need to ask then is, are you willing to stay on and transition the business if you are integral to the success of the business going forward? A purchaser is going to approach the business and want to understand whether or not customers are going to show up to buy product or services if you're not present in the business. And they also want to consider, maybe customers will come, but you're such an integral part of this business, they may not stick around for very long, or they may not get the same customer experience without you, and that can go and affect, really the value of what they think they're buying. So often when an owner manager is, integral part of the business, we see them being asked to stay on to help transition the business. That can be a matter of weeks where you're sort of sharing or helping the purchaser navigate your financial keeping or your financial software, some of your records, and then you step out after a few weeks and the new owner keeps their fingers crossed that they've got everything to hand to continue the success of the business. We've often seen owners stay on for a matter of years. And when that's the case, there's a number of ways that that sort of process can be structured. It can be that you step away from the business as an employee and you come in under what's called the transition services agreement, or you step on as a consultant and you're sort of paid a fee to stick around and help transition the business. What we also see is that your continued service in the business forms part of the consideration that the purchaser is willing to pay to acquire the business, what can be called sort of an earn-out. So effectively, as long as you stay in the business, you continue to participate in the business's success in the number of months or years to come, you will receive a portion of the proceeds that the business brings in, or a fixed bonus amount if the business meets certain key performance indicators, whether that be revenue based, brings in a new number of customers, maintains certain earnings targets, or exceeds certain earnings targets. Again, having your advisors involved in that conversation early can help you structure that earn-out process or that transition services process to make sure that you are getting good value for any effort that you continue to contribute to the business after you're no longer an owner. It's also important to consider how that relationship's going to look. Are you selling the business outright and have no control over management of the business, but are really still being expected to contribute to the financial performance in order to achieve that earnout? Or will you have a hand in running the business and maintain some control over the operations of the business, such that no senior employees can be terminated without your consent, No significant contracts with suppliers can be terminated without your consent, allowing you to continue to have some control over the operation of the business, even if you're no longer a direct owner, so that you really have some ability to continue to achieve those earnings targets or those other key performance indicators, and then control some of your ability to then achieve those earnout targets. Another issue to consider is how efficient your systems and processes are, and Darren's going to speak to that point as well.
Yeah, thanks, Renee. Just going back to your point about the owner, and this is really, really important that, when we talk about risk to the buyer and the multiples, it's the more important that you are as the owner to the operation of the business, really the harder it is in the sense it's going to be to sell. So when we talk to clients who have come to us and say, hey, I'm thinking about retiring, I'm thinking about selling my business, one of the primary objectives is how can we start to remove you from the day-to-day operations now so that when it comes time to sell, you're really not that important. And that drives then into, will customers return? Will employees stay on as well, right? Once you go, all things, again, we want to reduce the risk to the buyer. Aligned with that is your systems and processes. And this is why we see, franchises being so popular, because they're just turnkey operations. No one needs to recreate the wheel at each location. And really, pretty much anybody can buy a franchise and be relatively successful because all the processes are in place and they're very clearly laid out. So, do you have efficient processes for, order taking, purchasing, delivering, invoicing, customer account collections? Are you relying on people's memory or paper notes to blow around the shop when the door opens? Or are these processes automated, right? And we're seeing more and more clients moving into spaces where they're using technology to automate these things to make, again, make them less people reliant, and then more predictable. So our office does a lot of work in the cloud accounting space using QuickBooks Online, and they've created an entire ecosystem of apps that are best practice type of applications that handle all of these different areas that plug directly into your accounting system and automate them. So, taking some time, and when I'm talking, a year or two before sale, and working through these and updating your systems and implementing a lot of these automations will go a long way to help to generate you value.
Mm-hmm.
Renee, you had
Darren
some
spoke,
comments on.
Darren mentioned earlier the importance of having up-to-date, current, and comprehensive business contracts and agreements. Again, this goes similarly to how efficient are your systems and processes. How well have you been keeping your corporate records? You may have some long-standing agreements with employees, suppliers, customers, but like Darren mentioned, there's a risk to a buyer that goes away as soon as you step away from the business. So buyers are going to look to minimize their risk, and they're going to look to your records to give them a sense of how well organized your business is, how definitive some of these business processes are. Do you have a supplier or your key suppliers locked in for 5 years in an airtight contract that they must continue to perform at a certain level, and that contract is then freely assignable to the buyer, so the buyer gets the benefit of those terms? You're going to want to consider what documents you do have in place, what documents should be put in place, and what the terms of those contracts are, with a buyer's perspective in mind, to consider what it is that they may be looking for in those agreements to protect themselves when they come in, and to give them a sense of comfort that you've got a well-organized business, a well-oiled machine, that you've turned your mind to some of these issues, and that you've been minimizing your risks in the operation of your business, so they can get some comfort that they're not inheriting any risks that were unforeseen or that were foreseen and weren't dealt with.
Yeah, thanks, Renee. A couple other quick items just on value. So, take a look at your equipment and your inventory. Are they old, sort of obsolete items? I mean, when you think about it again with selling a property, are you selling a fixer-upper where, somebody's going to have to come in and do a bunch of heavy lifting to get the business to where it needs to be? Or are you trying to, again, sell something that's a little more turnkey? Now, that will depend, going back to the beginning, on who your buyer or, what type of buyer is looking at your business. And if it is somebody who's just interested in certain assets, it's not unlike somebody buying a property in an old neighborhood as an infill redevelopment, right? So, I mean, if they're going to tear down the house and really all they want is the land, it probably doesn't make a lot of sense renovating the inside of the property before you sell it. So, you need to think long and hard as to, what is that transaction, who that typical buyer would be for your type of business, and whether or not some of these efforts that we're talking about will actually result in a positive return on the investment that you make, both in time and money on some of these things. I talked a little bit about financial reporting before. I'll just touch on it again. Again, most of the time, the buyer is buying an income stream. So they want to be able to see reliable information on profits and cash flows and over a number of years, right? And the interesting thing with buyers is they might want to see information that you don't currently look at as an owner. They may have ideas of information that they want so that they can understand how the business operates, seasonalities of the business. So if your only financial information is something that you get from your accountants at the end of the year that goes with your tax return and they're just 12 months snapshots of activity, that may not be enough to satisfy the buyer. They may want to see it by month, they may want to see it by quarter, and they want those all to be reliable. So having some great accounting information that's current is very, very important. And we always talk about in our business, and it's consistent everywhere. Garbage in is garbage out, right? So if your data is not great during the year and you're just reliant on your accountant to fix it up at the end of the year end, that certainly meets your needs for likely reporting to the bank and filing your tax return, but that may not meet the needs of a potential buyer. Renee?
Yeah, so carrying on from what Darren was saying, it's important to turn your mind to what about your business may be valuable on the open market, and then taking the steps that we've just discussed to help increase the value of your business. So there's things that may not seem obvious to you that would be potentially quite valuable to a buyer. For example, do your employment agreements contain non-compete provisions, which would effectively prohibit your employees from walking across the street post-closing and working for a competitor? If a purchaser is buying your staff as part of the deal, they might consider that to be very valuable because they've got sort of a guaranteed bank of people still there willing to work who can't just jump ship and go to a competitor. Doesn't mean they can't quit, but it makes the likelihood of that happening less. Another thing to consider is things like your intellectual property. Have you protected it? Have you registered your trademarks? Do you have any patents that you could have registered? And protecting those items, because a purchaser, again, might see significant value in there. And sometimes it's hard when you're, intertwined with the business and you see the value in one spot to sort of take a step back and look at your business from the outside and try to pinpoint where there might be extra areas that you could create value to help you sell your business to a potential buyer. And this is where we also sometimes recommend engaging the advice of a chartered business valuator to help you identify areas for concern and other areas where you might be able to create extra value. And people hear, chartered business valuator, don't those cost tens of thousands of dollars? Is it really worth it? There's plenty of people who will do limited retainer engagements and will review your financials, take a broad look at your business, and really help to identify these maybe undervalued areas of your business that you could take a couple of steps to a couple of actions that would then help increase the value in that space, and also help you identify the areas that you agree are valuable and really increase the value in that space to a potential purchaser. It's also good to get a sense of how the market might view your business at this moment in time. Are there competitors out there that someone might have strategic insight that they're really acquisitive right now, and these are the types of businesses they're buying up, and you just happen to be on that list. Well, that's great. You already know that there's a purchaser out there that might be a good fit for your business, and you can keep that in mind when you're reviewing your records, reviewing your systems and processes, and talking to your advisors about where there's areas, again, to take a couple of steps to help increase value in the market. From a legal perspective, this is always my favorite topic, is organizing your records for due diligence. So as Darren mentioned, a purchaser is going to come in, they're going to want to look at your financials, first and foremost, probably to get a sense of the financial position of your business. But any sophisticated buyer is going to come in and they're going to want to look at your entire business operation. And that's including your minute books, your material contracts, your employment agreements, your organizational charts, your vendor lists, key customer lists, your permits, your licenses. And so turning your mind to all the things about your business operations that a purchaser may want to look at, and getting all of those records up to date, reviewing them, organizing them, putting them online. So either in a cloud-based system or even just in a database internal to your business. Getting all of those documents organized can really save you time and money down the road when the purchaser comes knocking and asking for those documents. And again, that's where Darren and I and our teams can assist you in preempting some of those requests, telling you what we know a buyer is going to be asking for and what they'll expect to see, and reviewing those documents with you to identify risks, pitfalls, gaps, and help you bring those records up to date and get them organized for purchaser and purchasers, financial advisors, and legal advisors to be reviewing. Another key consideration is whether there would be any consents that would be required for you to sell your business. So you might have a line of credit with the bank, and if you try to sell your business, that's going to be considered an event of default under your loan. And so you're going to want to have conversations with your bank fairly quickly about whether or not they'd be willing to consent to a sale of your business to a purchaser. Same with your landlord, same with any regulatory bodies that have issued permits or licenses for your business. And again, your legal counsel and your financial advisors can help identify those considerations early in the process and help reach out to those parties and initiate the conversations to get those consents rolling, because it is not infrequent that a regulator is not brought into the loop until the last minute, only to find out that it's going to take 6 months to get their consent to close this transaction, and now everything's blown up. So we like to consider whether third-party consents are required early in the process, so we can help dictate the timeline around those consents. Darren's going to talk to us now about putting your business to the market.
Yeah, just a couple of brief points. And, often we'll have owners approach us because they've perhaps had an unsolicited offer. And that starts to generate the conversation about selling the business. But, the best price will typically be achieved if there's more than one buyer at the table. So, that's where we like to direct our clients, is to think about how are you going to promote the fact that this business is for sale and attract as many interested parties as possible. The sort of other professional that we've kind of talked about today, indirectly when we talk about a chartered business valuator, is potentially a qualified business broker. Now, all chartered business valuators are not brokers, and all brokers are not necessarily chartered business valuators, but they can. There are individuals out there that are both. You want to be careful. I mean, I think Renee and I have seen this many times where we have brokers that aren't helping with the process, but the right party, and we can certainly help introduce you to some of those, are ones that will help with a lot of that Renee was talking about with respect to, getting your data room and getting all this information prepared, bundling the business, and then being able to go out to the market and actually attract more buyers to the table. Now, one of the big issues that comes out of that is, okay, what information am I sharing now? And, when do I start sharing some of this information? And Renee's got certainly some great experience in that area. I'll turn it back to you.
Definitely, yes. So, the sale process itself can unfold in a couple of ways. If you've got a number of purchasers that are interested in your business, what you may find, and especially if you have a broker involved, is that you sort of put a little teaser out to the market. It's a generic description of your business that doesn't give away any trade secrets or any sort of key identifying information. And then purchasers who may be interested come to the table and say, okay, yeah, I'm interested. I want to get access to a data room. I want to get more information. Before you share any information about your business with any third parties, outside of your professional advisors, lawyers are ethically bound to keep your information confidential, but before you talk to a purchaser or purchaser's advisors, we strongly recommend that you put a non-disclosure and confidentiality agreement in place. And these documents are very common in the sale process, but if you are not working with advisors, you or advisors on your side, you may find a purchaser just sends a document over and says, sign this document up and then send me your financial information. And unbeknownst to you, in that document, there's a non-compete clause or a non-solicit clause, meaning if the deal falls apart and the purchaser doesn't acquire your business, you now can't hire anyone who worked for the purchaser for the next 3 years. And so we highly encourage you to, on your side, to protect your interests, get a non-disclosure agreement in place, but also not to sign anything that a purchaser puts in front of you without speaking to legal counsel, so that we can help avoid you being unduly bound by a contractual provision that is actually in fact harmful to your business if this deal falls through. So to probably take a step back, what does a non-disclosure agreement mean? At its basis, it prevents people with whom you share information about your business from sharing that information broadly or from using that information to their own advantage. So it's a way of protecting your proprietary information, your trade secrets, essentially anything about your business that is not generally available to the public from being used to someone else's advantage or from being shared outside of the relationship between you and the purchaser. We would normally want to include, particularly where an industry is close-knit, in that non-disclosure agreement, what's called a non-solicit or a non-compete clause, which I just mentioned can sometimes backfire against you. We would want to include that in that agreement so that if a purchaser comes in, gets your employee list, they are not able to go and contact those employees and entice them to come work for them. Or if they get access to your customer list, they can't call up your customer base and then entice them to leave your business and come work with them. So it's really a way of trying to preserve as much of your confidential information, as much of your proprietary information from being used to your detriment if the deal falls apart. And normally the NDA stays in place until the transaction closes, and then you each go out your separate ways, but the purchaser, if it's a mutual NDA, you as seller are then still prohibited from using any information you might have learned about the purchaser after the transaction closes. So NDAs can also become particularly important where you may be offered equity consideration in the purchaser. So I think we'll talk briefly in a few minutes about deal structures themselves. You may find that a purchaser is interested in having you receive part of the consideration for the sale of your business be shares in their business. As part of your due diligence in that case, you're going to want to look at their business and say, is this a business I want to be invested in? The purchaser is also then in that case going to want a non-disclosure agreement in its favor, so that if it's sharing any proprietary information about its business with you, so you can consider obtaining equity in its business, that you can't then go and take that information and use it to compete with the purchaser. So again, like I said, non-disclosure agreements should be bespoke. They should be drafted for your particular business circumstances with the industry in mind, with the purchaser in mind, and we strongly encourage that you do not find anything that is put in front of you by a purchaser or by purchaser's advisors without seeking legal counsel, because we've seen our sellers succumb to pitfalls many times, inadvertently signing something that turns out to be quite harmful to their business. And then Darren's going to talk a little bit about what might be negotiating in this case.
Yeah, thanks, Renee. So just a couple of quick points, because and there's as you're getting the sense and listening to what Renee is saying, there's lots of details going on, right? So when you start getting into the negotiating process, have some consideration as to who's really at the negotiating table, and are you doing this on your own, or do you have somebody helping you on your behalf? And again, I'll relate it back to selling your home. There are obviously lots of properties that are sold by owner, and the purchaser and the seller are in the same room. But the vast majority has an agent or agents involved, and that's who you're negotiating through. And there's a couple of quick points there. So one is, it's a very time-consuming process, all the stuff that we're talking about and the information requests going back and forth. We often find that business owners get so drug into the process of selling their business that they've actually stopped effectively running their business. And in those unfortunate situations where the deal falls through after 90 days, 120 days of going back and forth, the owner finds that they've got all sorts of problems in their business. Sales are down, things aren't operating as efficiently as they should be. So now they're left with fixing their business before they can really, show it to somebody else again. Some of our clients who have used, third-party brokers or lawyers involved in that negotiating part of the process have felt that it was very good value, because they were able to just continue with their day-to-day and run their businesses. The other point is this is an emotional thing. You're emotionally invested in your business. It's been part of your life for a long time. And sometimes hearing, directly from the buyer what they think about certain things, or they think of value, can be a little bit difficult to hear. And it can often be better to have that buffered a little bit by a third party. Renee?
Mm-hmm. Yes, and so carrying on with what Darren said, your deal is going to be your deal. It should be tailored to you. The purchase agreement should be tailored to you and your business. And there is no standard agreement that will fit every transaction. And so working with legal counsel, working with your financial advisors can ensure that the deal that you get at the end of the day is the best possible deal that you could have achieved. And taking as Darren mentioned, taking the emotion out of it and actually focusing on the fundamentals and the facts can actually go a long way. And especially when it's lawyer dealing with lawyer, or financial advisor dealing with financial advisor, we can, while advocating for you and advocating for your position, take our emotions out of it and deal with the facts at hand. And that often does result in a more cohesive process, a more pleasant process for everybody involved, and especially for you, because you get to deal with one person, or your financial advisor, your legal advisor, and you're not having to deal with perhaps a purchaser that has a team of 6 lawyers telling you what it is, and you have nobody there to help you navigate that process. You can often get pressured into agreeing to things that just wouldn't happen if you had a legal advisor there advocating for your position. And as I reiterated, or as I mentioned before, and I will reiterate again, you really shouldn't sign anything without getting legal advice, whether it be a non-disclosure agreement, whether it be a letter of intent, whether it be a purchase agreement. Anything that you're going to put your signature to as part of this deal should go through legal counsel, just to ensure that you are minimizing any risks to your business, especially if the deal falls apart. You want to make sure that you can just pick up and continue operating your business as you were before, and you're not hindered in any way, that there isn't any ongoing liabilities that you might be subjected to. So I think next we're going to explore deal structures. So we've talked about identifying your priorities in the sale process, identifying your areas for risk, increasing the value of your business, bringing your value to market, or bringing your business to market, utilizing your advisors. Well, then how does the deal actually work? There's 2 typical ways that deal sales in this case are structured. One is a share sale, and the other is an asset sale. So if you think about it, if you have your corporation sitting right here, you are the shareholder that sits above, and your business sits below. If you decide you want to sell the shares in your business, the corporation below and all the business below will flow over to the purchaser, and the consideration sale of the shares in your business goes directly to the purchaser to you. If you want to sell if you decide to sell the assets of your business, you as shareholders still sit up top, the corporation sits here, the business sits below, and it's the business that goes over to the purchaser. Consideration flows from the purchaser back into the corporate entity. And so in both cases, there are tax advantages that can be gained in the structure. And there's also other considerations like comprehensiveness of a purchase agreement in that case, timelines that need to be considered. Asset sales tend to be favored by purchasers because they can come in and actually cherry pick what parts of the business they want to acquire and what liabilities they might want to leave behind. Those tend to be more complex. They require very detailed due diligence. They can take longer just because of the complexity of the transactions. And they also tend to be more costly in terms of advisor fees just because of the detail that is required in drafting a purchase agreement that deals with each specific asset that's going across, each liability that's going across, and any assets and liabilities that are staying behind. Where share sales, while due diligence is still an important part of the process because it's a whole corporate entity that's going across, we don't necessarily need to list in the purchase agreement every asset that's held in the business, every liability that's held in the business. That being said, they tend to be favored by sellers, largely because of the tax advantages that can be gained in a share sale versus an asset sale, which Darren is going to discuss. That's his specialty.
Yeah, we'll get to that in a couple of minutes. Just a quick follow up on the share versus asset sale, and it's this is where early planning is really important because you may have assets in your corporation that either you don't want to sell or that maybe the buyer doesn't want to buy. So we'll often see operating businesses with that have a building, a physical location that they operate out of, and to sell both of those, both the business and the building, might be more than what the typical purchaser is willing to put at risk. So they may be saying, hey, we want to buy the business, but we don't want to buy the building. We've got another location we're going to operate out of, or maybe we want you to be the landlord and just lease it back. There may be non-business assets that are in the corporation. You may have be invested in a rental property or a piece of vacant land that you're just holding for gain purposes. All of these things we need to kind of dig into and decide what needs to be moved out of the corporation before the sale happens. And with the right amount of planning, we can effectively do that and minimize tax. Yeah, go ahead, Renee.
No, I was just going to say, so to reiterate Darren's point, again, I sound like a broken record, but involving your advisors early in this process can help you, again, identify some of these redundant assets or assets that the market isn't going to find valuable, help reorganize your business in a way that's going to be most attractive to a buyer, and reorganize it in a way that can help minimize any tax consequences to you, whether it be an asset sale or a share sale. Just sort of get the business legally structured in a way that's going to give you the best tax position and the best position to put the business forward to a purchaser.
Yeah, thanks, Renee. And so just real quickly on the tax side, because this again could be another entire webinar, so I'll try and drill down what could be an hour into 3 minutes. You'll hear about tax advantages of a share sale. Typically for a Canadian taxpayer, they have a lifetime capital gains exemption that's currently just over $900,000 on the sale of qualified small business shares. So the key word there is qualified. So if you have to be the shareholder of the corporation as an individual, so not necessarily a holding company, and the underlying assets that you're selling within that corporation need to provide that the corporation qualifies. So it's not available to everybody. Sometimes with some planning, and again, maybe 2 years ahead of time, we can structure things so that the exemption becomes available. But what does that exemption mean? Well, for a typical, Sorry,
we had a question. Can we use either one of you as advisors, or do we need a lawyer?
Well, I happen to be a lawyer, and Darren is a financial advisor and tax advisor. So we together would make an excellent deal team for you. So we would encourage you to utilize both of our, both KWB and Field as your advisory team. We both bring sort of specialized knowledge to the table in our respective areas of expertise. I keep reiterating, don't sign anything without talking to a lawyer, because as far as the contract that you will be signing or entering into goes, a lawyer should be heavily involved in that process. A lot of the stuff that a lot of the matters that Darren spoke to as far as finding value in your business, identifying any systems or procedures that could be improved, making sure your financial history is robust, and actually structuring the transactions. You know, Darren and his team would add a lot of value in that space as well. So we would each bring something to the table and would work together as an advisory team to help a seller get the best result.
Yeah, I totally agree. That's a great response. And typically these conversations start with one of us, right? One of our clients will come and you know, Renee and I and you know, your accountant and your lawyer should know what they don't know and know where they need to reach out to somebody else. So that conversation with me is like, hey, here's all the things we need to look at. Now we need to bring in a lawyer to help advise in this area. So just jumping back quickly to the tax numbers, because as an accountant, I got to talk about numbers for some point in the presentation. But for a typical shareholder, being able to sell a business for roughly around $900,000 would equate to approximately a $200,000 tax savings, as compared to if you were just selling assets from within the corporation. Now that can be multiplied by, you know, depending on how many shareholders are currently in the business. So if the business is owned by a husband and a wife and you're selling it for $2 million, there's upwards of $400,000 tax savings by having a share sale. So, you know, it's a significant number, and we want to, you know, always take a good look at it and make sure that we have an opportunity to take advantage of it if it's available. Now, with that being said, real quickly, there's this nasty little provision in the Income Tax Act called alternative minimum tax, and it's there to take some of the fun out of the game. So when we have a share sale and somebody's claiming the exemption, there is this extra layer of tax that often can come into play. So on that $900,000 sale, if a person had $100,000 worth of other employment income, they might still have to pay about $44,000 worth of alternative minimum tax. Now that tax is potentially recoverable over the next 7 years if we can plan out income and taxes appropriately. But I think it's just really important just to plant that seed that, you know, somebody gets excited and they're like, hey, I'm selling this business for $9,000. You told me it was going to be tax-free. Well, it is kind of, but that $44,000 works out to about 5% of the sale proceeds. But nonetheless, you know, this is where we want to get in early, do a bunch of planning so that we can set it up so that we can take advantage of this. So Renee, what's next in this step?
So again, this is one thing that could probably be a seminar or a series of seminars in and unto itself. Is now we're actually at the point we've got a purchaser identified. What's next? The next document that I would expect to see in this transaction is what's called a letter of intent or a term sheet. This isn't present in every deal, but I happen to think it's probably the most important agreement, the most important document, because this is really where the parties come together and negotiate the most important terms of the deal and try to agree on them up front. If you can negotiate a really robust letter of intent, you will very often save a lot of time, cost, and effort in negotiating the definitive agreement down the road. So a letter of intent is exactly what it sounds like. It's often non-binding, but nonetheless, the parties come together, identify the key deal terms, which can include things like purchase price, deal structure, any conditions to closing, being, for example, any regulatory consents that are required, any third-party consents that are required for financing, if the purchaser needs to get financing from a bank in order to pay the purchase price. It really helps the party gauge each other's appetite to get the deal done. So if you're at the letter of intent stage and your lawyers are negotiating on your behalf a number of these terms, and you find out right up front that there's just no middle ground, say, on purchase price, or there's just no middle ground on structure of the earnout, and we really just can't find that place. It doesn't happen often, but it does happen. It's better to learn that at this stage of the game rather than when you've now done 6 or 7 terms of a purchase agreement, you're 6 months into this process, and you find out that actually we don't think we can get this deal done because the parties just can't agree on some of these critical terms. So we highly recommend negotiating a robust letter of intent prior to starting on a definitive agreement, which is the next document in the process. And again, this is going to be the binding agreement that actually will sell the business from seller to buyer. There's a lot of information that goes into a definitive agreement, but most importantly, it apportions risk at the end of the day. So not only does it legally transfer ownership of either shares or assets from the seller to the buyer, but it also portions who's going to be responsible for any lingering liabilities that might come out of the woodwork down the road, and who's going to pay for the costs associated with those liabilities, and for how long, and in what quantum. So we spend a lot of time thinking about things like indemnities, limitations on liabilities, representations and warranties, and negotiating those terms in a definitive agreement to get our sellers the best possible outcome at the end of the day, keeping in mind the state of their business, how long they've been operating it for, and their individual appetites for risk and priorities in getting the deal done. Do they want to get the deal done for the highest possible purchase price, everything else less important? Or are they really concerned about protecting themselves going forward, even if it might mean a sacrifice in other areas like purchase price or other ongoing responsibilities? And then next, there's a whole bunch of legal paper that happens to actually get the deal done. Often once the definitive agreement is signed, the seller will actually be working with the purchaser to start doing a transition of the business preemptively up until closing. So whether that's notifying employees that the sale is imminent, working with their bank to get the financing in place if it's the purchaser, getting all of those third-party consents that we talked about, getting all of those lined up so that when closing comes, everything's in order and the transition of the business is as seamless as possible. And we did put a bullet point there for timelines. We've seen deals that can be done in a couple of months, and we've seen deals that have dragged on for over a year. So it's really important to talk to your advisors early in the process, as I've mentioned many times, often, and discuss any issues that are our job as advisors to discuss any material issues with you as soon as they come up, so that the expectations of the parties to meet a particular timeline can be realistic and then can hopefully be met in accordance with the timeline that the party sets at the outset. So we did it. We're 3 minutes to spare for hopefully a good Q&A though. Anything to add, Darren, before we wrap up? Oh, you're on mute, bud.
Thank you so much.
No problem.
Just one last quick point. So we talk to our clients often about working on their business instead of working in their business. So working in is you're on the tools, you're delivering the services, you're making things happen. Working on your business is when you're focusing your efforts on improving things, right? And it takes a lot of effort to do that. But think about it from the perspective of reaping the rewards of improving your business. You have higher profits, better cash flow during your period of ownership, and you've just created 4 to 5 times that in value when you go on the exit. So, start thinking about it today about how do you run your business better, and that will lead to a higher sale price.